Anytime we talk about assets and specifically non-current assets, your mind will picture items such as land, buildings, office equipment, plant and machinery, and other tangible non-current assets. However, it must be understood that the definition of an asset is broader than this, and it includes items in form of resources that possess specific features which include the fact that they generate future economic benefits or money to the entity. In this video, you will learn about one group of non-current assets called intangible assets as covered under IAS 38. Hello and welcome to the accounting feed. My name is Philan and I'm your host for this session. Now let's start by defining an intangible asset. Intangible assets are non-monetary assets that do not have physical substance. In layman's language, you cannot touch or feel these assets. Some of the examples include license, trademarks, copyright, purchase goodwill, and brand. Recognition of intangible assets. Recognition can be defined as a process of incorporating items into different elements of financial statements such as assets, liabilities, equity, income, or expenses. For intangibles to be recognized as assets, the following conditions must be met. 1. They should be a resource controlled by an entity as a result of past events. 2. It should be probable, that means more likely than not, that future economic benefits or monies will flow into the entity as a result of controlling them. 3. We should have a reliable estimate of cost. 4. They must be separable, that means it should be possible to identify them separately from the other assets as well as the entity itself. With these conditions in mind, we can therefore conclude that internally generated brands, customer lists, publishing titles, mastheads, etc. cannot be recognized as they are not separable. We can also note that any expenditure incurred on intangibles that do not meet these criteria must not be capitalized. Instead, they will be recognized as expenses in the statement of profit or loss. On the same note, the standard IAS 38 does not allow expenditures to be reinstated back to intangible asset. Initial measurement. Measurement refers to the determination of values attached to different elements of financial statements. With regards to intangible assets, these will be measured or recorded at cost initially, that is, at the very date of acquisition. The double entry for this is as follows: debit intangible assets, credit cash or bank. Subsequent measurement. At the end of each year, the entity has to record the intangible assets at their book values or carrying values. Carrying value in this case is calculated by deducting accumulated amortization from the cost. Amortization is a systematic allocation of cost of an intangible non-current asset over its useful or economic life. This only applies to intangible assets with finite useful life, that is, those assets with a limited period of benefit to the entity. If an intangible asset has an indefinite useful life, that is, there is no foreseeable limit of the period in which the company can benefit from them, they cannot be amortized. Instead, they will be tested for impairment. Like depreciation, amortization is recorded as an expense in the statement of profit or loss. Its double entry will be as follows: debit amortization expense, credit accumulated amortization. There are two acceptable models that an entity can use, namely cost model and revaluation model. Let's start with cost model. Cost model involves recording an intangible asset at cost on initial measurement and amortizing it over its useful life. In this model, amortization is calculated as follows: you take the cost of an intangible asset and you divide by its useful life. Revaluation of fair value model. This involves recording an intangible asset initially at cost and revaluing that asset as necessary to get the fair value, then amortizing the fair value over its useful life. Once revalued, the cost of the asset will not be used anymore. Instead, the fair value will be used. In this model, amortization will be calculated as follows: you take the fair value of an intangible asset and you divide by its useful life. Revaluation obtained is recorded in the statement of other comprehensive income. Its double entry would be as follows: debit intangible asset and credit revaluation. Research and development. According to IAS 38, research is an original and planned investigation undertaken with the prospect of gaining new scientific or technical knowledge and understanding. Any expenditure on research must be written off in the statement of profit or loss as an expense. Development, on the other hand, is the application of the research findings to a plan or design to produce new or substantially improved materials, devices, products, processes, systems, or services before the start of commercial production or use. Note that development does not include maintenance or enhancement of ongoing operations. Development expenditure must be capitalized if all of the following conditions are met. So I'm using an acronym PIRATE here. The first one, P. It should be probable that future economic benefits will flow into the entity. I. The entity must have an intention or ability to use or sell the product. R. We must have a reliable estimate of cost. A. The entity must have adequate financial or economic resources to complete the development. T. The entity must demonstrate technical feasibility of completing the intangible asset so that it will be available for use or sale. And lastly, E. The product is expected to be profitable. If any of these conditions are not met, development expenditure will be expensed. Take note of the fact that capitalization commences when the management are confident that the product being developed will be profitable or economically viable. And that means that all these conditions in this acronym have been met. Capitalization stops or ceases when the product being developed is ready for its intended use or sale. That means the product is complete. Amortization begins when the entity starts commercial production. Intangible assets in the financial statements. As noted earlier, intangible assets are recorded in the statement of financial position at carrying values. This is the case with capitalized development expenditure as well. In the statement of profit or loss, however, the amount to be expensed will be determined as follows where applicable. So you take research expenditure, add development expenditure incurred before the management confirmed the viability of the product to be developed, and lastly, add amortization of development expenditure. So that total there appears in the statement of profit or loss. This marks the end of our session today. Thanks for watching. If you are interested in accounting and finance topics, make sure to subscribe to this channel, The Accounting Feed. If you have any questions on this topic or on any area that you'd like us to do a video on, please post it in the comment section below. Feel free to share this video and channel with anyone you know might be interested in this type of content. And until the next one, cheers!